Hello, this is Dr. Nunez. Welcome to ACC 350, Chapter 2 lecture. So we're talking about cost volume profit relationships, CVP relationships. There are some basic assumptions that we make in this chapter that allows us to perform the calculations that we need. First, we assume that the selling price is constant. So the selling price or the price per unit is constant. We also assume that costs are linear. That means we've got costs that are characterized by straight lines, not curvy lines, but straight lines. So, when we talked about variable costs and fixed costs and mixed costs in chapter one, well, those are linear relationships, right? This is a fixed cost. It's a straight line, a linear line. Variable costs extend out of the origin like that. That's a straight line. It's a linear relationship. And then mixed costs intersect that y-axis. They start here. Again, you have a mixed cost that is linear. So when we talk about these relationships, these are linear relationships. And we're not going to talk about multiple products, but if we were going to include multiple products, then we'd have to make some assumptions about the mix. But again, we're not going to talk about multiple products. So the contribution approach, let's start by going back to that contribution approach to measuring income on the income statement. On a contribution income statement, we have something that looks like this, right? We've got the total sales revenue of 250,000 minus the variable expenses. All the variable expenses gives us the contribution margin, and then minus all the fixed expenses, that gives us our operating income. And we can also express the items on this income statement on a per unit basis, like we've done here. So the sales revenue or the price per unit, if we take the 250,000 and divide by 500 bicycles, we get a price per unit of $500. If we take the variable cost of $150,000 and divide by 500 bicycles, we get $300 per unit. And the price per unit minus the variable cost per unit gives us the contribution margin of $200 per unit. So we've got a price, and I like to call the price P. That's kind of our selling price. And the variable expenses I like to refer to as V. And then the contribution margin is just that CM. It's the contribution margin per unit. So again, P minus V gives us that contribution margin, the contribution to those fixed costs. And that's all that we typically will measure on a per unit basis, because the fixed costs are going to vary every time the number of units changes. The average fixed cost or the per unit fixed cost is going to change. And we can also go a little bit further here. We can express these items as percentages. When we do that, we are expressing everything as a percent of the selling price. So the price is always going to be 100%, because we're just taking everything and dividing it by the price. So let me switch to typewriter mode here. It'd be easier for me to do this. So if we want to know what the selling price is, again, if we're expressing everything over here in this column is expressed as a percent of sales, kind of like on a vertical analysis of the financial statement. So if we were to take the 500 and divide by 500, right? That's how we get that 100%. On the other hand, if we wanted to express the variable expenses as a percent of sales, then it would be 300 divided by the 500, right? And we would end up with 60%. So the contribution margin, right, is just, the 200 as a percent of the 500, which is going to be the 40%. So essentially what we're saying is we're just expressing all of these line items here as a percent of sales. So let me clean this up just a little bit. Let's get rid of this here. So what I want is the eraser. There we go. So if we just get rid of this and express all these line items as a percent of sales, right? Then what we're saying here is, again, the price is the base. That's 100%. The variable expenses are 60% of our sales. The contribution margin is 40% of our sales. So again, all we're doing is we are expressing every line item as a percent of our sales, right? So the sales minus that variable expense ratio, that's what the 60% is. It's the variable expenses as a percent of sales. 60 cents out of every dollar, or 60% of our sales price, ends up being variable expenses. And we end up being left with 40 cents on the dollar. Contribution margin is 40% of our selling price. So we can express, this income statement in total dollars. We can express the income statement on a per unit basis, right? Divide everything by the sales volume, divide everything by 500. That gives us the per unit numbers. Or we could express these numbers as percentages. Divide everything, right? Divide everything by the price, right? Divide that $500 price, and we can express those variable expenses and contribution margin as ratios. And that contribution margin is really a very useful tool. It is a very powerful tool. So in this case, again, this company has a contribution margin of $200 per unit. And we can use that for analysis going forward. But the good thing about this contribution format income statement is that it is analysis ready. And it helps us understand and helps us to be able to see some key relationships. And one of the key relationships that we like to look at in this chapter is what's called the break-even point, the point at which the total sales just equals all of our expenses, or the point at which we have zero profit, zero revenue. And that's only going to happen when this is true. It's only going to happen when our fixed expenses are just equal to our contribution margin. That's the only way you get zero here. The only way you get zero operating income is when your contribution margin just equals your fixed expenses. And for this company, it happens at 400 bicycles. When they sell exactly 400 bicycles, when Q, the quantity sold, just equals 400, then they get enough sales revenue to cover all those variable expenses and to cover all the fixed expenses, and they break even. So that's our break-even point. And that's looking at the break-even point on the income statement, on the contribution format income statement. So if they go beyond break-even, if they sell one more bike, if their break-even point is 400, but if they sell one more bike, what's that going to look like? Well, the income will be 200. And we don't even need an income statement to figure that out. Why? Because the contribution margin is 200. Every time you sell another bike, what you get is $200. Every time you lose the sale of another bike, what do you lose? $200. The fixed expenses are constant. Doesn't matter what happens. Volume goes up, volume goes down. Your fixed expenses are fixed at 80,000. That's the nature of a fixed expense. It's constant in total. But what will change will be these items that vary. Sales is 500 per unit. You sell one more bike, you get another $500. Your sales go up $500. You sell one more bike, your variable expenses go up $300. You sell one more bike, your contribution margin goes up $200. And your fixed expenses are constant, so your operating income has to go up $200 every time you sell another bike. That's how powerful this measure is. It's going to tell you what happens to your income every time your volume goes up a unit or every time your volume goes down a unit. Contribution margin, very, very powerful measure. So in this case, we don't need to prepare an income statement, right? We can estimate profit at any volume because we know the contribution margin is 200 units. So if we sell 30 more bikes, how much more income are we going to get? $6,000. And we don't need an income statement to figure that out. It's just 30 units sold times $200 of contribution margin per unit. That's how we can get that income. That's how powerful that contribution margin measure is. We can use it to predict our income because we know the fixed expenses are constant. All we need to know is how much more contribution margin we're going to get. That's how much more income we'll get. And we could, if we wanted to, look at it on a graph. So graphically, let me shrink this down a little bit. When we look at this graph again, we have the activity on the x-axis, right? And we have the total dollars on the y-axis. These are the fixed costs here, right? So the fixed costs are constant in total. This is the total revenue the green line extending out of the origin. So revenue looks a lot like that variable cost line because it extends out of the origin, because the price is constant on a per unit basis. So the total revenue is going to vary directly and proportionally with the activity. And this blue line is the total cost. It's that mixed cost. You put the fixed cost and the variable cost together, you get kind of a total cost line. So that's the total cost line. And the break-even point is the point at which the total revenue just equals the total cost. That's where you break even. You break even here where you sell exactly 400 units. That's what your fixed costs are. They're constant. Here's what your total costs are. Here's what your total sales revenue is. You break even right here, right at that dollar level. That's your break even point. Sales dollars of 200,000. So we could calculate break even on a graph, but we're not going to do that. We can be more accurate and a lot more efficient when we use the equation format. So in this case, one of the things that we also need to be able to do is easily calculate that contribution margin ratio. Now, I did it for you a little bit earlier, looking at that contribution margin income statement. But you want to keep in mind that if you have total dollars, you can calculate the ratios. If you have per unit dollars, you can calculate the ratios. You need to be able to do it both ways. So in this case, if we want that contribution margin ratio, we can just take total contribution margin divided by total sales dollars, and we get that ratio, right? So I did it earlier using the per unit numbers. You could use it, you could calculate it using the total dollars. Total, in this case, contribution margin dollars over total sales dollars. So every time we have a dollar increase in sales, we're going to see a 40-cent increase in our contribution margin. That's what that ratio tells us. So we can use total dollars, 80,000 over 200,000, or we could use the per unit dollars, like I did earlier, $200 over $500. It doesn't matter. You're still going to get a contribution margin ratio of 40%. Every time you have another dollar increase in your sales, you're going to see a 40-cent increase in your contribution margin. And the variable expense ratio is just variable expenses, again, as a percent of sales. And we could do that using total dollars, which is what we're doing here. Total variable expenses of $120,000 over total sales of $200,000. So variable expenses are 60% of sales. Every time you have another dollar in sales, you got 60 cents in variable expenses. And again, we could do that using total dollars or using the per unit numbers. So the relationships, right? You want to make sure that you understand contribution margin is that contribution to fixed expenses. It's the sales minus the variable expenses. That's what that ratio is. It's based on sales minus variable expenses. So the contribution margin ratio is also just 1 minus the variable expense ratio. So in the example that we're looking at, 1 minus a variable expense ratio of 0.6, right, gives us that contribution margin ratio of 40%. That's where that's coming from. We could use total dollars, we could use per unit, or we could just take the variable expense ratio and subtract it from 1 to get the contribution margin ratio. Doesn't matter which way you look at it, right? So again, when you go back to this income statement, this is that break-even point, right? And if we find that we're going to increase our sales, right? If the sales increase, right? If we're able to sell more, $50,000 more in sales dollars, what's going to happen to our income? Well, 40% of our sales is contribution margin ratio. So 40% times the increase in sales tells us how much our income is going to change. Very powerful measure, this contribution margin ratio. So the equation method, now that we understand how to calculate that contribution margin ratio, along with the variable expense ratio, using the equation method to calculate some of the variables that we need, starting with break-even analysis. So here's our basic income statement. We've got total dollars here. We've got per unit dollars here, right? So the total dollars divided by the volume, 500 bicycles, is always going to give us our per unit numbers, right? 250,000 divided by 500 gives us 500. 150,000 divided by 500 gives us 300. And 100,000 divided by 500 gives us 20. So the per unit numbers and the ratios Well, again, everything divided by sales. So the 250,000 divided by 250,000 is where that 100% comes from, or just 500 divided by 500. And same thing for variable expenses. 150,000 divided by 250,000, that's 60%. Or 300 divided by 500 is that 60%. And then same thing with contribution margin. Take the per unit, 200 divided by 500, or 100,000 divided by 250. Doesn't matter whether you use total dollars or per unit dollars, we can calculate our ratios. Now, we need to be able to use them. Let's start with break even. So if we want to calculate the break-even approach using more of a shortcut, the units to break even, right? We don't want to look at a graph. We don't want to look at an income statement. We just want to be able to quickly and efficiently calculate break even. Well, the basic equation is those fixed expenses divided by the contribution margin per unit. And when I start working on problems, I'm probably just going to use F for fixed expenses divided by that contribution margin per unit, right? So the fixed expenses of 80,000 divided by the contribution margin for per unit of 200 means we're going to break even, right? That break even. And I like to refer to this as that break even Q, right? The number of units that we need to break even. 400 units. Break even Q is the 400 units. So the unit sales, right? The break even units. The number of units that we need to break even is based on this basic formula that we'll be using to solve the assigned problems. Break-even Q is the fixed expenses divided by the contribution margin per unit. Contribution margin per unit. And again, the contribution margin per unit is the price minus the variable expenses, all those variable expenses, price minus the variable expenses. So that's how we can quickly and efficiently calculate the break-even point. Now, if we want to calculate break even, and I'm going to call this break even in dollar sales. So not break even units, but the dollars, sales dollars that we need to break even. Well, it's the fixed expenses, right? So again, F, the fixed expenses divided by the contribution margin ratio. Contribution, that is a C, sorry for my bad writing. The contribution margin ratio. So that contribution margin ratio, and I'm just going to erase that. That just looks terrible. So the contribution margin ratio, right? That contribution margin ratio, if you will, is the contribution margin expressed as a percent of sales. So if we take the fixed cost divided by that contribution margin ratio, we end up with break-even dollars. And again, this CM ratio, the contribution margin ratio, how do we get that? Well, we could use total dollars, or we could just take the contribution margin and divide it by the price. So the contribution margin on a per unit basis divided by the price per unit gives us the CM ratio, or total contribution margin divided by total sales. Either approach will give you the ratio. And the fixed expenses divided by the ratio gives us the break-even dollar sales. So the break-even dollar sales here is based on taking the fixed expenses divided by the contribution margin ratio. 200,000. They need $200,000 in sales to break even. So here we determine it's 400 units. They need to sell 400 units, break even Q, that's units. They need 400 units to break even, or that is $200,000. Or another shortcut approach that I like to always point out. If you take the price, if you multiply the selling price, which is actually $500 per unit, right? If you take 400 units, right? Because that's what this is, it's 400 units, right? If you take 400 units and you multiply times the selling price, right, of $500, right? So price times volume always equals sales dollars. So the price times volume, 400 units times $500 is 200,000, right? 400 units times $500 is our break-even sales dollars. So if we already have break-even point, 400 units, just multiply times the price, and it gives the sales dollars, break-even sales dollars. Sometimes companies want to go beyond just breaking even, right? They don't want to just break even because they're in business to generate a profit. So we want to modify this formula and call it the target profit analysis. We want to know the unit sales that are necessary to attain a target profit. So we just take our basic formula, right? So we take the target profit plus the fixed expenses and divide by the contribution margin per unit, right? So it's not break even Q, it's kind of I'm going to refer to this as kind of a TP, right? This is a target profit, right? Target profit dollar, target profit in units, right? So we're given a profit target in dollars, and we want to determine the number of units, right? The number of units that we have to sell in order to generate that target profit. That's what that is, right? It's a formula that allows us to calculate the number of units that we need to sell in order to generate a certain profit, a certain profit target. And it's just the profit target in dollars plus the fixed expenses divided by the contribution margin per unit. So in this example, if they want to earn $100,000, so they don't want to just break even, they want to earn $100,000 in profit. Well, the formula again, so this is what I'm calling the target profit, right? Target profit in units, or let's just abbreviate target Q, right? So a target profit Q is units, Q is units. So that target profit in units is just $100,000, a profit target, this number, right? So they want to make $100,000 and they have $80,000 of fixed expenses divided by the contribution margin per unit. They need to sell 900 units. So TPQ, target profit Q, or units, they need to sell 900 units to generate that profit. And if we want to know what that target profit is in dollars, right? So that target profit now in dollars, not units, but dollars. Well, anytime you need dollars, divide by the ratio instead of the per unit number. So now we're dividing by the contribution margin ratio, not the contribution margin per unit. So the target is $100,000. Again, we've got $80,000 in fixed expenses, and the ratio is 40%. So they need to sell $450,000 in sales to generate a profit of $100,000. And then the last thing that we look at here is what we call the margin of safety. The margin of safety is the cushion, the difference between where you're at and the break-even point. So we're looking at the excess of the budgeted or the actual sales over the break-even point, right? So this is budgeted or actual sales here, right? Minus the break-even point. And that'll tell us how much cushion or what our margin of safety is. So in this case, these are actual sales. They got actual sales of 250,000 and the break-even sales are 200,000. So again, the margin of safety, so I'm going to call this the MS, right? The MS in dollars. The margin of safety in dollars is the actual sales dollars, right? Minus the break-even. Minus the break-even dollars. And again, those actual sales, we got $250,000 in actual sales. Minus the break-even sales. Well, the break-even sales are $200,000. So the margin of safety that we have here is $50,000. We got a margin or a cushion between where we're at, the actual sales of 250 and break-even sales. So we could afford to lose up to $50,000 in sales. That's our margin of safety. And we wouldn't suffer any losses, right? Anything beyond that 50,000 and we're in a loss position. So the difference between where we're at actual sales of 250 and the break-even sales of 200 gives us that margin of safety, the MS dollars. And then the next thing we have is we can also express that margin of safety as a percentage. So the margin of safety now percentage. The margin of safety percentage is the margin of safety dollars divided by those actual sales. And we just determined that the margin of safety dollars is the 50,000. And we want to divide by the actual sales, which are 250,000. So we're going to end up with a margin of safety percentage of 20%. So that margin of safety, or that cushion of $50,000, actually represents 20%, right? There's a 20% difference between where we're at and the break-even point. And that's the amount that we could afford to lose and not suffer any losses. But go beyond that 20% or beyond that $50,000, and we'd be in a loss position. That's what that margin of safety tells us. So we've looked at a lot so far in chapter 2, but we'll go through some examples. We'll work through some problems and exercises. So I will see you. That's the end of chapter 2. I'll see you in the chapter 2 problem solving session. Take care.